All right. Welcome, folks. Happy Friday out there in Zingerland. I am your host, Ryan Faloona, and I am here with BigBeat as always. And today we have a very special guest. We have Shane Fleury, CFA, the Chief Investment Officer of Elevate Capital and the President of Elevate Ventures. Gentlemen, welcome.
How are you, Ryan? How are you doing today?
I'm doing pretty good. How about yourself, Stephen?
I tell you, I am really looking forward to this webinar. We have today Shane Fleury of Elevate. If you don't know, I'm actually friends outside of all this nonsense of trading and stuff. So I actually am friends with Shane. So I'm excited to have Shane on the webinar today.
Thanks, guys. Pleasure to be here.
Shane, tell me, how's the weather out in Colorado? You're out in Colorado, right?
Yep, that's where I am today, and that's where we live and have our office. It was -1 when I woke up and took the dog for a walk this morning, so a little chilly out there today.
That is my kind of weather. Oh, I love it.
Did you just say -1 degrees?
That's right. A little different than Treasure Island, Florida.
It's 65. I'm a little cold today. I actually put a jacket on today for you, so there you go. All right, let's get started, Shane. So I know you quite well, but tell us a little bit about yourself, how you got started trading and how you got into the investment world.
Yeah, so tell you what, I started out in finance, a job in the mailroom at Nationwide Financial. That was my first taste of what it was like to really work inside. Before that, I was landscaping and washing cars and doing all types of things like that. So my mom was an executive assistant at Nationwide, and so one summer I got tired of doing the landscaping gig and took a job in the mailroom over there. So that was my first exposure to anybody in kind of white collar work. And from there, I got a job as a customer service representative and then a wholesaler for the annuity products. And then one day I decided it was time to move to Colorado, and now here I am.
And that wasn't yesterday, was it? That's how long has it been now?
Moved out here in July 2011. So yeah, I've been here for, I guess 8-9 years now. It's awesome.
You're old hat at all this now. All right. Yeah. So now you're at Elevate. Tell us a little bit about Elevate.
So Elevate, we have a few different companies here under the Elevate brand. The first one is Elevate Capital. We're a registered investment advisor. We manage about $100 million today. About 30 million of that is in 401k plans. We also have a firm called Elevate Insurance, where we help people solve some of their estate planning needs. I don't really touch that too much. That's mostly my partner Ken. And then the other thing that I probably work the most on is our company Elevate Ventures, which is investing primarily in young startup small companies in the esports industry, and we have a crypto hedge fund as well. So I do a lot of trading for the main registered investment advisor. So all of the portfolios that we manage for clients, we do the trading in that every day, and then I spend a lot of my time trying to raise capital for our venture companies.
And I'm excited about that. Where you don't just have stocks and bonds, the old boring stuff. You actually have alternative investments as well. I mean, I think that's very cool.
It's certainly a lot of fun and a lot of work.
All right. So you mentioned your mother earlier about getting you at Nationwide. What does she do now?
Yeah, so mom is facilities manager. She might have gotten a new title actually recently, but over at a company called Trulieve Cannabis.
All right.
So they're a multi-state cannabis operator. I think they've got, they mostly have, I guess, over 40 dispensaries in Florida. And I think some in Connecticut, and I think business going on in California and maybe Texas or something like that. But they're a pretty big deal, and we are actually investors in that company. It's publicly traded. You can find their symbol in Toronto. I think it's TRUL in Toronto, and here it trades on the pink sheets under symbol TCNNF.
Yes, and Benzinga does have cannabis conferences, and the CEO of Trulieve, Kim, she comes to the conferences. She's an amazing speaker, by the way. So if you haven't done the cannabis conferences with Benzinga, I encourage you to do so. All right, so let's be honest. You are a CFA 3. That is a big deal. Can you explain, first of all, what a CFA 1 is, and then what a CFA 3 does?
Well, yeah. So CFA to be a CFA charter holder, you have to pass 3 levels of the CFA exam. So level 1 is very broad based and kind of just to see how much random information I think you can memorize. Level 2 is a bit more of a deep dive on how to actually manage portfolios, and level 3 is mostly focused, I felt like, on behavioral finance and planning and those types of things. But it's one of the, I think it's the broadest area of study and probably the most prestigious credential you can look to get in the financial services industry, which is why I went for it. So that was I skipped college, right? So I tried college a couple of different times. I lasted for a quarter each time. Wasn't my thing. But teach me about money and how to trade and how to value things. And I like to understand at a really deep level how this stuff all works. We sit here and look at these screens all day. You probably see my head looking around watching, but I got, I don't know, 12 charts on that screen and another 6 over here for crypto, and we're watching it all the time. So I just, more than looking at the green and red bars on a chart and just trading them, I like to kind of understand what's going on behind it. And so the CFA probably would not endorse much of my technical trading that we do, but fundamental analysis is kind of gone out the window. I mean, fundamentally value Tesla for me, or Virgin Galactic. I think I saw Virgin Galactic the other day traded at a price to sales of like 1,300 or maybe 1,600 times sales, not earnings, sales we're talking about. And don't get me wrong, I traded that stock. I bought it at $12.50 and sold it for 18 or 19, somewhere in there. And then it went to 38. So the fundamentals have kind of gone out the window at this stage of this market cycle. And these days we're mostly trading based on technicals, based on price breakouts and breakdowns. And I know we're going to get into a little bit more of that maybe now, but I know we'll talk a bit more about that later.
Interesting point. Those of us who've been trading on fundamentals for years, we're kind of out of our league, out of our depth now. We don't really understand what's going on. Do you think this is a new millennial thing pushing the markets up? Is it the Fed still pushing the market up with the sugar bowl, as I call it? What's going on here?
Yeah, well, there's, this time is different is always a dangerous thing to say. But I like to say that this time is unique, and it is. It's always unique.
Right.
It's not necessarily different. I think there's a lot of factors at play. And you mentioned a few things there. So millennials and Fed and all that. The Fed and its liquidity is certainly one of the biggest things that I see that's pushing these valuations up and holding them up for long periods of time. But fundamental analysis isn't dead. I mean, it's not totally useless. I think that we use that to identify companies that we want to be in, fundamentally speaking, for the long run, and then we use technicals to identify good times to add to or trim those positions. And so, there's always room for both. And I think it's really helpful to understand when something is just, not trading on any fundamental valuation basis at all. And so don't look at that, right? I mean, if you went and did a screen for the best fundamentals out there, you're going to find stuff like ExxonMobil. And ExxonMobil has been a great company for decades and decades and decades, and probably isn't going to go to zero. But 4 years ago, you could have bought Exxon for $100 a share, and today it's 60 or something. So, you can go and beat the value drum and beat the fundamental. I can't buy Tesla. I can't buy Tesla. It's too expensive. It's like, well, I realize why you feel that way, but you're leaving money on the table. I mean, if you know that it's overvalued and it's going to get more overvalued, you have to decide whether that's a good place to park a little bit of your capital or not. And we don't trade Tesla, frankly. I've made some money on trying to buy some puts there, but I've mostly lost in recent days. So we don't really trade that one too much, but a lot of people are having a lot of success with it. So
do you trade any cult, as I call them, cult stocks? Do you trade any of them?
Personally, yeah. Sorry, 1 second here. Yeah, personally, I'll mess around with that stuff. Especially things that like I have high conviction on that I know I can ride out, or I'm playing with money I can afford to lose, that kind of thing. Our clients don't give us money that we can
You have any stock tips for today for us, Sean?
Oh man, no, not really. I think the most recent stock I added to my personal portfolio was CRISPR Therapeutics, I think is what their full name is, but in the gene therapy space.
Yep.
I liked that they had sold off and come down towards the 200-day moving average, and that held as support. So, buy that with a stop loss right underneath the 200-day, and if it just gets back to its recent high at the end of last year, that's a 50% gain. And of course, there are options out there that you can use to lever that up a bit. So, CRISPR is one that I think is in a decent spot right now. It's actually down 4% today after being down a bit yesterday. They had earnings end of last week or something like that. So, still like that one for now, even though it's not working out over the past 2 days.
Okay, well then that's good. Then tell us. So you and I talked about this. Your technical trading, you love your charts, and we know that. And so tell me, what are the things that you're looking for in a chart? I want to have Ryan give us a chart. So let's go ahead, Ryan.
You got it.
You want to pull up CRISPR? That's cool. That'll work.
Well, I had True Leave up here because we talked about that on the intro, but I'd be happy to pull up CRISPR.
Yeah, sure, that works.
All right. So tell us your indicators that you're looking at.
So these are the indicators that I would add to the chart, and I mostly do it in this order. The first one is the 200-day moving average, and we use the simple moving average over the exponential. The exponential tends to, what it does is it weights the recent history a little bit more heavily. But we want all 200 days in our moving average to be represented equally. And then after that, I'd add the 50-day moving average. Yeah.
Now, on this chart, it looks like we're getting close to the 200-day moving average.
Yeah, if you look closely back on February 3rd, it came down and was for about 49.83 was the low that day, and the 200 was 49.33. So I think it got within about 50 cents of its 200-day moving average. At that point, and then held as support. So that's something that we would look at as a little bit of bullish activity. But I think technicals, again, even along with fundamentals, we use them as confirmation. We don't use them as one technical indicator is gospel, and that we should trade it and follow it and only it. We like to look at a number of different things and understand how those technicals work together and whether they're providing conflicting or confirming information. So, the next thing, and the 50-day moving average that you just added there, that's our shorter term indicator. I tend to also look at the 10 and the 20-day indicators, but you don't need to add those for right now. That'll just make things a little harder to see there. So the next one that you would add is the MACD, which is the moving average convergence and divergence, which helps us understand momentum a little bit. And if you zoom in a bit on that February 3rd date, you'll see that just shortly after it held the 200-day moving average, the red line there, it also shows me what I call a MACD bull cross. So when the short-term moving average crosses the long-term moving average and the histogram becomes green from red, that is a signal to either take profits on a short or maybe even consider going long. So in that particular scenario, I saw that the 200-day moving average had held, and we had a positive momentum to go ahead and take the trade. So I started getting in around that time when the MACD crossed to the bullish side. The other indicator that we watch, and I basically look at on every single chart from crypto to Exxon to CRISPR and everything in between, is the RSI.
Yep.
So that'll just tell us whether it's cheap or expensive based on its own price history. And again, just because something is overvalued does not mean it won't become more overvalued. And because something is undervalued doesn't mean it won't become more undervalued, right? So we don't look at the RSI as an example of a time to go short or take profits necessarily. If you look at that last RSI spike that you see down there, I don't know if that was probably on an earnings date. That was 11/20. So no, it wasn't even an earnings. They must have just had some news come out. So that's one other thing I'll say is that news always trumps charts, right? You could use your charts all you want, but if a news headline comes out that says, CRISPR Therapeutics is Enron, game over for your chart, man. It's not, they do not work in situations like that. So, but you could see that it spiked there, and it got to an RSI that was sort of extreme, and it looks very overbought. But that was only very overbought in the very short term. It went down for a couple of days after that, but then raced back to those highs. So we would be looking right where your mouse is now. We would be looking at that MACD cross from bullish to bearish, right? After the price rise. You see the RSI is now falling out of an overbought state, and that's a real good opportunity to get short a stock. And I mean, so there's a perfect example of using technicals to complement what you're doing as a fundamental analysis. I mean, CRISPR Therapeutics, gene therapy, this stuff is in its infancy at best. I mean, it's brand new, and people are just getting started with it. And there's really no telling where it can go and what can be done with it from a health and other benefits for society. So I mean, this could be, imagine buying Amazon at 54. There were lots of different times where you could have played short-term puts or even shorted Amazon stock in the interim, even though you love the long-term fundamental thesis. So that's one of these examples. I did not short CRISPR at that time. I was just looking for a place to get in. And so when it came down from there and held the 200-day moving average, and then the MACD crossed back to the bullish side, I thought that'd be a good time to take my initial position. So,
are you a long-term bull here on CRISPR?
Yeah, definitely. And not because of valuation. I mean, if you look at the valuation, it's going to be stretched just like everything else in the market. But just because something's stretched doesn't mean it can't grow into that valuation. If their revenue and their earnings grow exponentially, like I expect that they will, if you look at what is the price today compared to what will they earn 2 or 3 years from now from a revenue and earnings perspective, it's probably not that expensive. Now, we don't know exactly what they will earn 2 or 3 years from now. We have to speculate on that for now. But come back to this in 2 or 3 years, and you'll get to see how expensive it was. And going back to my example of ExxonMobil, their earnings aren't growing. Their earnings are shrinking. Their revenue probably isn't growing very much either. I haven't looked at that in a while. But
are you buying long-term calls here on CRISPR then?
Nope, I actually just took the equity. I've been looking at calls and might take that approach too. But for now, I'm actually just trying to focus on holding equity for the long term, and I'm actually doing that in my personal accounts across the board because we've just gotten so busy managing money for other people that I don't have time to babysit the theta exposure in a lot of options. So we're mostly selling options these days, man. We're trying to be the house, and we're having a lot of success with that. So the last thing I'll say about this CRISPR chart is if you look back to the last time we went down to the 200-day moving average, you see it actually dip below, maybe by 5 or maybe even 10%, depending on what that looks like. But so that's why I have my stop not right at the 200-day moving average. I mean, these lines on these charts are not very specific. I mean, you don't trade them that way. At least in my experience, you look for it to consolidate around that level. And if you'd set your stop right at the 200-day, you'd be out of that right before it went on a massive run. So, I'll set mine down a little bit lower, maybe 5 or 10% below the 200-day moving average, because if it goes down that far, it's probably going to keep going down. And so that's where I'm at for today on that one.
Now, Shane, you had mentioned that you were a long-term bull on this. When you do that, do you often play like puts in the short term and then hold the actual equity for your long-term position? Is that something that you'll consider doing?
Yep, absolutely. I look at those as two totally separate instruments and two, mostly totally different trades. Covered calls is another thing that we'll do. If I think something is just done going out for a while, I'll sell covered calls if I own 100 shares of the thing. Sometimes if you're looking at Amazon, you gotta be playing with the big boys to be selling covered calls on things that are
covered calls. Now, there are a lot of people out there, Shane, that do not know what a covered call is. Are you willing to teach us what a covered call is today?
Yeah, I think. I can try and explain it the best I can. It's a relatively complicated deal, but not too much if you can put it into simple terms. So the way we typically explain how covered call works is, well, first here's the situation where you want to deploy a covered call is not when you think the security you're trading is going to crash. If it's going to go down by 20 or 30 or 40%, you just want to sell it. Covered calls are not going to help you here. You want to buy puts, protective puts, or just sell a position and book your gain. So covered calls more come into play where something has gone up a lot, and it might be really high. I mean, we can look at CRISPR since it's still on the chart. It might be at an extremely high RSI, and the MACD might be, also showing signs of rolling over. And you can just tell that the price is getting extended, but you're fundamentally long this stock, and you want to be in it for the long term. So you just want to protect yourself against maybe it consolidating or going down a little bit, but not crashing. And so the way we explain this is imagine that you say you live on a cul-de-sac where every house was built exactly the same way, and so your neighbor's house is just like your house. And right now, your house is worth $1 million, and you know that because your neighbor just sold his house, right next door. So nothing's really any different about these houses. And let's say, for example, your house was worth only $500,000 a few months ago. So it's going up a lot. It's doubled in the past few months, and now you could sell your house for $1 million. And you think there's almost no possible way that your house could go up to 1.5 million, right? It just doubled already, and so it's probably done going up for a while. May not even be worth $1 million. And so you have me. I walk up your driveway and I say, "Hey, I'll give you $10,000 for the right to buy your house from you in the next 30 or 60 days for 1.5 million." And you're looking at me like I'm totally insane, and you're saying, "Why would you do that? My house is never going to be worth $1.5 million in that short of a period of time." And so you're like, "Cool, I'll take your $10,000. I'll agree to that deal. If you want to buy my house for 50% more than it's worth today in 60 days, and you want to pay me 10 grand for the privilege, yeah, I'll do that deal." And then 60 days. Let's say there's two ways this works out. 60 days go by, and I don't come back and buy your house for 1.5 million. Your house is still worth $1 million, and you kept my 10 grand that I gave you, right? That would be the option, the call option premium that you got to keep. So you get to stay in your house. Your house is still worth $1 million roughly, and you kept an extra 10 grand. And you can go out and find somebody like me again and say, "Hey, I'll sell you this option on my house." And so you just keep doing that every 30 or 60 days or however long you want to agree to it for. And you might say, "Well, why would I give you that $10,000 for that right?" Well, I see something that's going up a lot. There's a ton of momentum behind it, and I think your house probably is going to be worth $2 million in 60 days. And maybe it's not worth that, but at least I'll be able to sell it to somebody for that much, right? And so if for $10,000 I can secure the right to make, say, 500 grand, right? In my assumption, I can sell your house for 2 million. I buy it from you for 1.5, sell it for 2 million, and all I had to invest at the time was 10 grand, right? So you can take your 10,000 up 50 times. So it's flipping the risk reward spectrum. When we sell covered calls, we're looking for an extremely high win percentage. We want to win 80 to 90% of our trades because we don't want to move. Even if you're going to give me an extra $500,000 from what my house is worth, I still don't want to go buy another house and move and hire movers and buy new furniture and whatever else has to happen. I'd rather just keep your 10 grand and stay in my house. So when we sell covered calls, it's not because we want to sell our position, but we sell covered calls at a price at which we would be happy to sell. So that way, if we get called away, we still make money for our clients. And if we don't get called away, then we get to keep the option premium. And the only way we lose money is if the stock goes down by more than the option premium during the time that we hold the trade. So we always use stop losses to get out of trades to protect us from crash risk. But when we see a stock that's gone up a bunch and it's probably just going to take a breather and do some consolidating, then we'll look for an opportunity to sell covered calls to generate a little bit of extra return.
Now, are you prone to rolling those covered calls over at any point?
Nope, not usually. We either we buy them back. If Square, what's a good example? There's a few good examples recently. AbbVie probably is a real good example.
Okay.
We sold covered calls on that one, I think on, the last day of December last year, and then closed it 35 days later. And we sold an option for, say, 95 cents, and we brought it back for 5 cents. So we captured 85 to 90% of that option premium. And yeah, we probably could have made the extra 5 cents. It probably went to zero. But, once you've made 95 or 80% of an option premium, and there's still 10 or 15 days left for the stock to go up a whole bunch and have that, have it all come into the money, you might as well just take your profits while they're on the table and look for an opportunity maybe to sell some stuff further out, or just maybe even buy the stock at that point. I mean, if it's gone down a little bit and you've sold covered calls along the way, now maybe you're looking for an opportunity to add to it yourself because maybe it's now looking a little bit more bullish, and the MACDs have turned around. The RSI indicates it's cheap. All those kinds of things may have changed in the interim. So we tend to sell at the money. Just maybe one or two above at the money. So not grossly out of the money where you don't get any premium, but not right at the money so that you're likely to get called away. And we tend to sell 60 days or less because that is the part of the option life where the theta is eating away at an exponentially fast rate, right? So it really gets going in the last 45 days. So sometimes we'll go out to 60 days if we're not getting enough premium in the shorter term stuff, but we don't usually do it for any longer than 60 days. We want to really take advantage of the end of the life of the theta.
I just heard the word theta. Are there any other Greeks out there that you're interested in? Big, I
don't pay too much attention to those when I'm trading. Sometimes I do if I'm trying to do a delta hedge on an earnings call. Like if I just want to neutralize the risk of an earnings, so we're not going to make any money or lose any money no matter what they report, then we'll look at deltas and we'll do a little bit of delta hedging. We don't do that stuff very often. I mean, earnings, more often than not, earnings are going to be positive and they're going to report beats and you're going to want to participate in that stuff in the long run. And a lot of times when a really good company fundamentally sells off on earnings, sometimes it's for silly reasons or short-term reasons, and you can look at that as a good buying opportunity. So we don't trade earnings very much. We certainly don't like to neutralize them very much. If I thought earnings were going to be bad for one of our companies, I'd probably be looking to get out of it, because exactly. bad earnings are bad fundamentally speaking, and there's so many different things out there that are just, I don't know, just fundamentally optimistic in my mind. I'm actually going to try and pull up a list of some of our our big themes. I mean, if you're looking at a company that's probably going to report crappy earnings, it means they're probably either a bad member of their industry, or the industry is not very good, right? But with things like esports and cannabis and blockchain and cybersecurity and robotics and automation, streaming video, drones, mobile payments, augmented and virtual reality, driverless vehicles, immunotherapy, 5G, lithium, China being added to MSCI indexes, space tourism. I mean, I go on and on and on. We've got a bunch of these, and
that's a long list there, Shane. I think we're going to have to copy and paste that here in the chat for everybody.
Yeah, well, and you can't invest in all of them. I mean, you have to choose. Like, you could invest in all of them. Don't get me wrong. There's probably an ETF that you could buy in every single one of those things now. So maybe you can. We don't. We like to pick the best players in the best industries and manage our exits from there. If it turns out that it's not moving like some of the other ones and we were wrong, we'll cut our losses and move on and find something else to invest in. So we're not married to any of this stuff. We're very agnostic about it. We're here to make money for people, and really, most of what we do is lose less when the market's going down. It just so happens that we're crushing the market to the upside right now, which is a lot of fun. But we make most of our money on the downside. Like I feel like a lot of people in I guess in the financial services and investment world, and especially on like StockTwits and Twitter and other chat rooms and things like that. I mean, people love to say when to buy stuff, but you don't get a lot of people telling you when to take profits and how to manage risk. And that's what I think separates most professional money managers apart from most retail investors, is that risk management piece.
I have a follow-up question on that. It sounds like you have a very specific plan, or as BigBeat always likes to say, a very specific thesis for how you take your trades and get in and out of them. Do you use the same plan for every type of trade? And then do you ever veer from your rules, break or bend them at all?
Great question. So one of the, I'll start with a quote that I can't quote exactly, so I'll paraphrase, but if you guys have never read The Complete Turtle Trader by Michael Covelli, you should check it out. They took kind of like trading places. They took just 23 random kids that didn't know anything about trading and turned them into profitable traders, and did this whole experiment. This guy wrote a book about it, and he goes through kind of, how they were trading and what they were teaching. And one of the quotes basically says, I'll never know much as Cargill does about the fundamentals of trading corn, but I can trade it successfully, and I can pull money out of that futures market. And most traders can never compete with the amount of research that some companies are doing in the oil markets or in certain commodities or even in a given stock or industry. And so he says, we're not trading S&Ps, and we're not trading corn. We're trading mob psychology. We're trading prices, which there's numbers on a screen. And when something goes up and breaks out to a new high, it's probably going to do that some more. That's momentum. That's the name of the game, and that's what these guys traded. They use different moving averages than probably work today, because once you've exploited a strategy, other people start to catch on, and that strategy falls out of favor, and maybe it comes back, right? But these rules are pretty rigid, and we do not bend them or break them once we've set them. So I always have, I use the same rules for everything, because everything to me is just a price on a screen. So from Bitcoin to ExxonMobil, the technicals behave the same way. When you look at the chart patterns and the technicals, you're seeing human behavior. You're seeing a timeline of how humans thought about and traded and valued a certain thing. And manias can go on in either direction, up or down, for a lot longer than rational people think possible. And so, if you're a rational person, you kind of have to throw that stuff out the window and say, look, this chart tells me that the momentum's going up, the price keeps going up. We add to our winners and we cut our losers. We don't average down, Yep. Don't get me wrong. If I'm trying to enter a stock, right, and it's going to be a little volatile, or even Bitcoin, it's going to be volatile for a couple of months, I'll have a range at which I want to buy it, and that range for Bitcoin might be $1,000 wide. Sure. It might be $1 or $2 wide for Exxon or something like that. But of course, we're going to try to accumulate shares at the best possible price that we can. But once we get into a position, once we've fully put the position on and we've decided what our exit strategy is, no, we don't change it. There are a few things that we do not use stop losses on, and that is actually, it's only one thing. It's property and casualty insurance companies. We do tons of fundamental analysis and read the earnings calls and understand what the combined ratios are for the insurance companies that we hold. And if they start operating at an underwriting loss, we're gone. But if they can make money on the so insurance is the best business in the world. It's the only thing that I'm aware of that has a positive cost of capital. Almost every other business, you have to go out and you got to build your iPhone and then sell it to somebody. So in the interim, you've spent money building the iPhone, and then you hope you can sell it to someone later. Insurance charges you a premium and then maybe has to pay out on a claim someday. In the interim, they sit on all that premium and get to invest it. They invest it pretty conservatively because it has to be there in the event that a claim gets filed. But, these guys, like Bill Berkeley started W.R. Berkeley from his dorm room at Harvard. Go look at a chart of W.R. Berkeley right now. Thing is going bananas. This is one of our longest term holdings at Elevate Capital, by the way. We held this in our client account since before we launched Elevate Capital, and before it split 2 for 3, I think, last year. But seriously, this is what insurance companies do. And so if you had sold on any one of those dips right there, you would look like an idiot. And it's totally overbought right now, and it's probably going to go down. We've been looking for opportunities to sell covered calls against it. But it doesn't have a very big option chain, and so we haven't found anything that we like to sell. So we've taken a little bit of profit off the table.
Would you say that, for me, I like insurers as well, but I like reinsurers better?
I don't necessarily discriminate between the two. I know that I like property and casualty insurance more than I like life insurance or any other type of insurance companies, because life insurance tends to have a smaller rate of return capability on that float. That float is the premium that the company gets to hold on to while they are deciding whether or not to pay out premiums or pay out claims. But everybody dies. So if you have a life insurance company that is heavily involved in permanent life insurance, 100% they're going to pay out a claim, because 100% you're going to die someday. So as long as you keep paying a premium, and the policy is enforced on the day that you die, then the insurance company is going to have an expense for that. In property and casualty insurance, how often have you filed? Think about auto insurance, for example. You pay all this money for your auto insurance. It's mandated that you have to have it by the government. And then invariably you get in a little fender bender or hit a pole or somebody hits you or scratches your car in a parking lot. And the first thing you do is try to not file an insurance claim.
Yeah.
I think it's the greatest business on the planet. They take all this money in, and then people actively try to not file a claim because they don't want their rate to go up.
That example really hits home with me because that literally just happened to me like last year in the summer. My car was scratched in a very, very insignificant spot, and I thought to myself, there is absolutely no way I would file a claim for this. I would absolutely take care of this myself, try to buff it out, wax it out, cover it up, do whatever. No way would I file that claim.
Yep.
And I pay my premium every 6 months. So
if you can. It's something that I've been looking for a long time, and if anybody out there has a ticker for me, I'd love to look at it. But I'd love to know who out there has the highest ratio of term insurance to whole life insurance. That's a publicly traded insurance company, because term insurance mostly expires worthless. Just like nobody's trying to die in the 20 years that they buy their term insurance policy for, right? And most people, this is why term insurance costs a fraction of what whole life costs, right? Is because most people live well beyond that term and never file a claim. So you can buy $1 million of term insurance for $50 a month, and $1 million permanent insurance might cost you $1,000 a month or more, depending on your age and health and all those kinds of things. So if you could find the right life insurer out there that just doesn't sell whole life insurance, they only sell term insurance, and they're good at underwriting over like a 10-year period, I think that would be a phenomenal business as well. But so anyway, there's always times technically speaking when something's overbought. Like we're not selling W or Berkeley, right? But like, look at that chart, man. I mean, there's never been a better time to maybe sell some covered calls versus that thing, or even trim your position because, gosh, you're up 3 or 4x, at least, and just in a boring old insurance stock. So there's always ways to trade around a long-term position, and the only deviation I'd say from our strategy of using trailing stop losses and appropriate position sizes is in P&C insurance, where we just don't follow a stop loss. We'll actually read the earnings reports and understand how it's called the combined ratio. How much money did they pay out in claims and how much money did they spend on expenses? That number combined, as long as it's less than 100%, means that they are making money on making money. They're underwriting profitably, and they're investing for a gain as well. And so it's a perfect situation.
All right. Well, you know what? I have been hearing about insurance for the last 10 minutes. Let's talk about some cool shit. Let's talk about some esports. I know you're big into esports, Shane.
Yeah, so when I mentioned my big ideas, right, esports was by far and away the first one I mentioned, followed by cannabis and blockchain, crypto. So esports, we've been involved with video game companies since I've been managing money. I think you've got EA up on your screen. That's one of our bigger portfolio holdings right now. Apex Legends has been great, and there's tournaments going on all over the world. People are watching on Twitch TV. Advertisers are getting involved because the kids who are playing this stuff are very, very difficult to reach. I mean, they're not watching cable TV, and to another extent, they're just like looking at their phone or looking at some type of video game screen, most of the time. And so you can turn on Twitch TV and turn on a video game stream, and the first 30 seconds is going to be a toilet paper commercial, because Scott's Toilet Paper needs to figure out how to get these kids to buy in. And don't get me wrong, I play video games, and I'm 36 years old. This is actually my video game headset right here.
I was going to say, I like that logic.
Yeah, you
have there. That's sweet looking. I'm 35. I play video games. BigBeat, I forgot your age, but I know you play.
46, and I'm okay with that.
I played Apex with BigBeat, so so anyway, this is not a new thing. This is not like the thing of the future. It's now. It's right now. It's been right now for a couple of years.
me ask you this, Shane. So about a month or 2 months ago, I took the opposite side of you on esports. I said esports is going to be happening down the road, but I said that because Xbox and PlayStation, Microsoft and Sony are backing off. These game makers are backing off a bit on the new games because they're waiting on the new console. Would you agree with that or not?
Yeah, I think there's definitely some of that going on right now. I'm personally short GameStop via some puts. I think GameStop is the new Blockbuster. That is, even though the new consoles, the new Xbox and the new PlayStation 4 are reported to be coming out with disk drives. I just think that the whole model of going to a store and buying a disc and then plugging it in it's going away. And these new consoles are going to have massive amounts of memory, and most things are going to be streamed and downloaded or played on Google Stadia.
DVD player to them then?
I'm sorry?
Why are they adding the DVD player to them then?
It's a good question. I don't fully understand it. Michael Burry, of Big Short fame, is actually long GameStop because he thinks that because of this disk drive in these games or in these new consoles, that GameStop will be able to fight off bankruptcy for longer than guys like me expect them to. So there's really smart people out there on the opposite side of this trade for me. And that's okay. I mean, there's a lot of room in esports and in video games. I mean, I don't know. I guess there's no easy way to say it. I grew up a poor kid in Detroit, and I would have been happier than hell to get somebody's hand-me-down Xbox when they got the new one and all their discs, and then go into a place like GameStop and look for used games to play. So, I mean, there's always that. There's probably an army full of people who run Airbnbs and other places like that might stash, the last model stuff in those Airbnbs, and people might want to actually bring discs with them. I don't know. I mean, I don't think there's much of a future there, which is why I'm short GameStop. But in the long run, this is the cresting of a wave that started building back in the late 1970s. People have been playing video games. I played in I went and looked it up not long ago. It was like 1990. I played in a video game tournament at Cobo Hall in Detroit. It was like, how fast could you get through the first world of Mario Brothers, and how fast could you get around a racetrack on whatever game that was? And, it was fun, man. And this has been going on since I was, 7 years old. I'm 36 now. And I think it's finally, time. I think now is the time for esports to shine. There's tournaments going on all over the world. People are winning millions of dollars. That 16-year-old kid won $3 million or something in the national Fortnite thing. It's crazy. And if you compare globally the viewership of like the World of Warcraft championships and the Super Bowls of esports, if you will, you probably have to compare it more to like FIFA viewership, really, World Cup viewership, because it's a global thing. I mean, people in China are playing games, and people in Brazil are playing games, and people in the United States, of course, are playing lots of video games. So this is a global thing. It's not just one country that's tuning in. And the advertising revenue that's available in this space right now is just, I mean, it's hard for the human mind to comprehend what's going on.
At Elevate Ventures, have you guys invested in any companies that may or may not be on the exchange, shall we say?
Yeah, well, thanks for the question. As you know, we're invested in a company called Nerd Street Gamers. NSG.GG is where you can find these guys, and they're putting up LAN centers, is what they're called, all over the country. There are mobile trucks that can show up to your high school and put on an esports event for your high school. These guys are partnered with the biggest and the baddest names in the industry, like Activision and Overwatch, World of Warcraft, Play Versus. Comcast is an investor in this company. So, I mean, these guys are doing it right. They're going from, a few locations, one in Denver right now, a couple in Philly, one in Los Angeles that's going up. And so these guys are getting big. They're going to be expanding across the country and hopefully internationally soon. And what you can do is, I mean, you literally can go in to a local host facility, and you can rent a top-of-the-line computer. I mean, the same stuff that the pros play on with the best internet connection available. So you can, as in my example, as a poor kid from Detroit, right? I could roll in here and play on the best stuff money can buy for like $10. I don't know the pricing offhand, and it changes from one location to the other, I think. But for like 10 or 15 bucks, you can get 4 hours of game time.
Yeah.
If you want to, the game time never expires. So if you go in and you play only an hour and mom says you got to go, you got 3 hours stashed for later. You can roll over to the local host and play some games with your buddies. And so esports has a big accessibility issue because the computers that you're playing on in here are they're $2,000 machines, and there's there's a monitor that's another $1,000 probably, top of the line mouse and mouse pad. Yeah, it's just really hard for people to afford this. And then of course, as soon as you spend the money, the stuff gets upgraded. And so, a lot of parents are just like, I can't keep you on top of the line stuff.
I'm not buying that again. I just did it.
Right. And if you're competing for thousands of dollars, right, you don't want your equipment or your internet connection or whatever to be the reason that you're not winning. I mean, if you're going to compete, you want to be on a skills basis, and that's what the industry wants too. So there's a couple of reasons that going to do this live and in person is a lot better than just, imagine just winning. Imagine you even won, right? So you got a worse internet connection and a worse machine, and somehow you still win the match, and you win $1,000, and you're in your basement by yourself, and yay, that's it. You do this at a local host arena in front of 1,000 people, and people are cheering for you and high-fiving you, and your teammates are sitting right next to you, and the guy you competed against is on the other side. It's just a whole nother level of competition that is more akin to what most of us grew up with playing soccer or hockey or whatever in real life sports there were.
And then people want to sponsor you and all types of things like that. It's crazy. I really quickly, I wanted to go back to your GameStop example. We also had a question about it. I just wanted to address really quickly.
Sure.
You were talking about the other side of the trade. And Steve, you brought up a really good question. Why are these makers still putting disk drives of whatever kind in their machines? And I'm a firm believer that one of the reasons for that is because there's a backwards compatibility that a lot of gamers are looking for. They want to be able to play some of their own games, and the only way that they can do that without rebuying the game digitally is to use their discs that are lying around, or Shane, like you said, passed down. So I know that that's a big market. I'm not sure that's big enough to warrant this decision on its own, but that's definitely something going on.
Yeah, that's a great point. It's too bad you can't, like with music, right? You could just turn it into an MP3 and shove it in your iTunes library. But in video games, as far as I know, that technology doesn't exist yet. But if you guys out there know of it, please post the ticker in the chat room, because that's a great idea.
And see, so and like just to use myself as an example in there, there's only one game that I have felt comfortable doing that. My favorite game of all time is Final Fantasy VII. I probably had a couple of sets of discs. Now I actually just rebought it for my PlayStation for like $15. I can't think of another title out there where I own the discs at one point that I then chose to buy it digitally for another reason. Now,
Twisted Metal. I'm telling you right now, Twisted Metal was
that was a good one.
Twisted Metal,
man.
yes, great
that was
call.
A
great call.
The one I rebought was Donkey Kong Country for Super Nintendo.
Oh yeah, that was a great game.
I have that one at home still.
I almost like bringing up Pitfall or something like that. Here we go.
So Pitfall was Activision Blizzard's doing, right? They've been doing this for a long time, man, since Atari. They've been around a while.
So I really like Nerd Street games. I am a big fan of, I'll be honest with you, so much so that, full disclosure, I'm actually an investor in the company as well. And I love the CEO there at Nerd Street Games. That's John Fazio. Big shout out. He's out here today. He's actually watching.
Awesome. Hey, John.
All right. Well, let's get right on.
Were you asking another question, Ryan?
Yeah, I wanted to get to the comment from Don Solo in the chat. Said that GameStop may be opening arenas, which would bring them back up. Opinion only, of course, not info. I agree with that. I think that actually might be one of the ways that they can kind of revamp things. If they do start opening GameStop arenas or even cyber cafes like you were talking about, if they opened up a network of those, they may be able to realize some better profits there. Now, as far as the technical trading, just looking at this chart, this stock is under its 200-day. This is a no touch for me until this is a close above the 200-day, and I feel good about that. So, I mean, to each his own.
I'll probably be out of my short if that happens too.
Say again?
I'll probably be out of my short if that happens too.
There you go. All right. So a close above the 200 days is a close the short there. So.
Yeah. So I'll just one more thing. We've seen a couple of these facilities that GameStop has developed. I think they're mostly in the Midwest. And I think we've sent some people out to physically visit and go into them. And there's no doubt that this is a step in the right direction for them. They have to go this direction or they're not going to work. I mean, even back in the day when you would go into GameStop, it was mostly to like play the new game on the consoles that they had sitting there. You know, like every time you walk into a GameStop, if there were two people in there, it was because one of them was playing the Super Nintendo and the other one was playing the Sega. And you would kind of browse and look around at games until one of them became available, and then you'd go over and play whatever the latest and greatest was for a bit. And that's where you'd hang out when mom was at the mall, or all those kinds of things. So we've seen a few of these. They're very much not local hosts. They're not a place for, I think, competitive gamers yet to go hang out. I think it's more the retail crowd that might want to just kind of check some things out. And I'm not aware that, well, some of them do have PCs and that kind of thing too. But localhost is more set up for like not being the after school hangout for where kids, just want to chill. And it's for the competitive gamer, definitely for the amateur that wants to get competitive and maybe want to think about turning pro. But it's not necessarily just to hang out and be the babysitter while mom's out shopping. They've got top of the line equipment, and they're there to kind of promote that competitive spirit. And not that anybody can't walk in and have fun there. Don't get me wrong, but it's just not designed to be a hangout.
Yeah, and most of the time that I spent at GameStop was actually not in GameStop. It was outside, in line, waiting for a new release. And now I don't have to do that, because if a game is released, I can download it digitally. I get to skip the line completely, and I just get to play it right there on the console. So great point. And then I wanted to address one other question not related to esports real quick. One of the questions was, once you set charts, how do you make sure that the indicators populate on each stock at the same time? That's actually a function that's coming in a few weeks here when we deploy real-time charts. It's going to remember all of the different indicators, and it's going to raise the cap from 3, I think, to like 10. So right here, Shane, I'm sorry, I can't put the 50, the 200, the MACD, and the RSI, okay. So I dropped the 50. But in a couple of weeks, you're going to be able to do all of that. Great question. So sorry about that.
All right. So, Shane, I'm going to close this out. The best part about your CFA is that you know risk management. And I think a lot of times new traders, old traders, all kinds of traders don't always really understand risk management. And I'm excited about risk management. I'm really excited about how to hear it from a CFA 3 of how you handle risk management. How do you put it in play?
Two primary ways. Position sizes, right? That's the only free lunch in the asset allocation or investment industry is to don't put all your eggs in one basket. And the most critical part of our strategy is that we follow trailing stop losses. And so we use a company to manage that, which is outside of the market. So our trades are not entered into the market. We get email alerts when our stops are hit, and then it's up to us to go and trade that the following day. So we use closing prices only. We don't use intraday prices for this purpose. Not when we're talking about managing book money, essentially. I might deviate a little bit from that in my personal trading, depending on what I'm doing. But when we're managing the book of business, we use trailing stops to exit our positions, and we subscribe to a service from TradeStops.com. They also have a crypto service that they do this for, so we use that for our crypto hedge fund as well. And essentially, they create a volatility statistic for every single stock, every single security out there for the most part. And so, any one security, say Apple, might have a historical volatility of 15%, while the trade desk, TTD, has a much larger volatility profile than say Apple does. And so, based on the historical volatility, that'll help us determine how much money we might want to put into a stock, right? This is kind of going back to risk parity. If you've ever read anything from Ray Dalio, is that we want to take the same amount of risk on a position, not necessarily have the same amount of money in every position. So in a stock that has a historical volatility of, say, 30%, we might only put 2 or 3 or 4% of our portfolio into that type of stock. Whereas with, say, Apple, for example, that has closer to 15% historical volatility, we might be willing to put as much as 8 or 9% into a stock like that. So we try to diversify our portfolio across at least 15, sometimes 20, usually not more than that, stocks. And we'll use ETFs if, like for right now, we own IWM, the Russell 2000 ETF, because most of the individual stocks we hold are in the large cap tech, growth type sectors. So we'll try and go get our exposure wherever we can get it. But for the most part, we're trading individual positions where we can sell lots of covered calls and trade around these positions a bit. And again, using those trailing stops as an indicator as to when a stock is misbehaving. As long as Apple or TTD, in my example, as long as they don't experience volatility that's wildly outside of their historical volatility, we're usually buying dips, right? I mean, the market in all is trending upwards. It's got some good momentum, and so until we get an indication that these stocks have begun to misbehave and experience price volatility outside of their normal structure, then we tend to kind of just sit on them and look for opportunities to buy. But once they do go down and breach one of these levels, we'll get an email and we'll go and sell the next day. We'll find a new stock that's cheap hated and going up, and we'll buy it.
I'm going to take the other side of that trade. I'm actually short the Russell 2000.
Yeah, and I bet your term is a lot different than mine, right?
Yeah.
And so you'll probably be out of your trade in a matter of weeks, and I'll probably still be long IWM as long as it doesn't go down and start breaking through 200-day moving averages and doing things like that. So, I don't disagree that it might be a good time to short the whole market in the short term. But for us right now, we've sold successfully covered calls on IWM a number of times, and then bought those calls back for a profit, and just continued to stay long that position for the long run. Because if you and I don't know if you can do it or if it's necessary right now, Ryan, but if you look at a long-term chart of the S&P 500 versus the Russell 2000, the Russell is just grossly underperformed for like a couple of years, I feel like now, and we're playing that over the long run. The Russell will catch up, and probably because the S&P might come down to meet it a little bit too. So it might be a little bit of a pairs trade opportunity where you could be long the IWM and short the SPY as a pair for a while, and just see if that convergence happens. But there have been a lot of people trying to trade that convergence for, I'd say, months now, and it hasn't totally happened. But we're pleased with our IWM trade overall. We got into it on one of those dips you see on the chart in front of you. So we're doing fine there, and I think people who are out there taking advantage of the shorter term overboughtness of things, I think there's probably money to be made doing that.
So real quickly there, if you don't mind. Sorry, Stephen. Looking at one of these dips here, I've got the 200-day pulled up here. The yellow line is the comparison to the S&P. Just hypothetically speaking, when you see some of this action here, like when IWM goes below the 200-day, I know you mentioned that if you were long, you would have a stop that was maybe 5 or 10% below the actual 200-day. Let's say you had no position and you watch the stock trade up to the 200-day and you get a close above. What is your trigger for entry, or what are you looking for specifically in order to enter that trade?
Oh man, that's a good question. Really, it's a lot of confirmation from the MACD. So if the MACD is also showing me the positive momentum, so like in that scenario right there, it broke through the 200-day. I don't know which happened first. Probably the MACD crossed bullish first, and then it broke through the 200-day. It wasn't yet overbought on the RSI schedule. So to me, all of those kind of confirm that now might be a good time to enter that stock. And in fact, the date that you're looking at, I think
October 15th.
Okay, so I think we got in maybe a little. I think we got in on the dip before that. I think that's when we opened the position. So like closer to maybe September. Yeah. September 5th, I think, is when we probably bought it the first time.
That would be right here.
Yeah, and honestly, from there, when I buy it there, my stop loss is going to be based on the historical volatility of IWM. So What I do, and I'm doing it right now, is I would go out to tradestops.com and log in, and I would find what the historical volatility number is. And it's a little bit different than what you might find in other places just based on the options. So they have a proprietary method that they don't even tell me how they do it, but I tend to find it pretty accurate. You can find other volatility stat providers, right? But the volatility stat for them at that, or for IWM at that time, was 12.52%. Today it's 12.35%. And so when we entered the position, we would have immediately put a trailing stop loss on at 12.5% from whatever that price was on September 5th there. So let me just look at that real fast. Say it was around 152.35. So 152.35 times 0.845 gives us a stop of 128.73, which is down below by a good bit the 144 low that you're seeing around that time too. So I mean, we're giving ourselves some room to stay long this stock. A lot of people think when you say trailing stops or stops in general that it involves a lot of trading, but it's actually the opposite. It's how we stay long, right? Like Melly is a great example. We're out of that trade now because we did stop out, but Mercado Libre, it went up, I don't know, from $250 a share to like 600 some before we ended up getting out of it. And all along the way, there were a number of spots where it was overvalued, the momentum had chilled out and started to go down, and the stock went down 15 or 20%. And if you had sold every single time it went down by 15 or 20%, you'd be pretty upset with that return. You would have been out very, very early. And so our trailing stops, right, knowing that normal volatility for IWM is 12.5%, it gives me the confidence to keep adding to the position until it gets down below that level and actually starts behaving outside of its normal volatility structure. Until then, it's still in an uptrend in my mind on a long-term basis. And for us, those are opportunities to be adding. So, back on that IWM chart, when it dipped, it didn't dip down below our stop loss. It didn't even come close to it at 120s. It came down to like 144. And so we actually bought a lot more when that happened, so a lot of times we'll put on a position at say at 2% of our portfolio. And the idea is to get it up to 5% over time, as long as the charts and the technicals continue to confirm our long thesis. So we don't put the whole trade on right in the beginning. And we're not, generally we add to our winners and cut our losers, but until it hits its stop loss, it's still in an uptrend in my mind.
And one more thing about that stop loss, as you were saying that, I found it very interesting as I'm looking at that chart. I believe you said that stop would have been 128 or in change on the IWM.
I think that's what I said, yeah.
Yeah. So I noticed by looking at the chart that actually is still above the low put in on December of 2018. So in addition to following your rules, you actually don't breach that other low from back in December of 2018. Yeah, so that's really good stuff right there. I love it when a plan comes together.
Yeah, like that. There you go. Perfect.
All right. Well, Steve, do you have anything else?
Yeah, let me. Melly was a great pick there. I'm a big fan of Melly. Most of you don't know Mercado Libre is the Amazon of Latin America. And if we took a chart of Amazon and compared it to Ryan, you can probably see where some of that money went flowing to.
Let's do it.
And there it is. Mercado Libre blew away Amazon, right? So some of the money was coming out and went right into MELA. So,
and you know what is my favorite aspect of the investment in Mercado Libre is not actually, that it's the Amazon of South America. But it's really, really heavy into mobile payments. They have, oh my gosh, I can't remember the name of it right now, but they're, it's like the WeChat or the Alipay also. So it's a lot of different things rolled into one, but I think where most of the upside is going to come from in the next leg up of this stock is going to be from mobile payments. I just think that was one of the big things or big themes that I mentioned earlier when I was going through the list, but I think that's the biggest upside that they've got going for
them. Good example of when you were saying that news trumps charts. eBay just coming out now. They're nearing a sale of classified units for $10 billion. So a good example of when things pop like that. All right, Shane. You know, when people ask me all the time, tell me the market makers are moving the market, I always ask them, tell them, well, who are the market makers? Because I actually know them. So tell me who they are, and I'll be happy to tell you. And Shane, you are one of them with over 100 million of AUM, assets under management. Man, I'm very proud to call you a friend and a colleague in a lot of ways. And thank you for having me today. I'm really excited.
Yeah, no, this was good, man. I had a lot of fun doing this. So anytime you want me back, I'll be here.
Thank you. I'll leave it to Ryan to close us out here.
And I would just like to start off by echoing Steve's sentiments. Thanks very much for your time today, Shane. This was incredibly enjoyable. Hopefully our viewers found it as educational as I know I did. Steve, you got some good connections. We really, really appreciate you bringing them on here for the Zinger crowd. So I just want to thank both of you for your input today. Really appreciate it. Can't wait to have you back on. Zingers, I hope you guys all enjoyed it. And just remember, until next time, happy trading.